हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है बिजनेस कॉम्बिनेशन, दैट इज इंडियन अकाउंटिंग स्टैंडर्ड 103 पार्ट 2, which talks about, in the previous discussion we had discussed about the definition of business combination. Then we had discussed the definition of asset acquisition, how asset acquisition is different from business combination. We had discussed the difference between business combination and asset acquisition, different methods of business combination with different scenarios and examples. In today's discussion, we are continuing our topic. Today we will discuss about the methods of business combination along with the steps, what steps they are following. So let's start our topic. Methods of business combination. There are two methods. First is the acquisition method or purchase method, and another one is common control transaction. First method of business combination is acquisition method. We can also say that it is a purchase method. Another method of business combination is common control transaction. What is acquisition method? When the business or entity is acquired from a third party, that is, transaction is outside the group. When any entity is acquired from other than the group companies, which is not in the group, then that transaction is to be treated as an acquisition method or purchase method. In that case, all the accounting is to be done at fair value. Suppose, for example, A Limited acquires subsidiary of B. A Limited and B Limited are unrelated parties. A Limited acquires subsidiary of B Limited and B Limited is not a related party of A Limited. B Limited has three subsidiaries S1, S2 and S3. A Limited acquires subsidiary 1 of B Limited. So they are not related. First of all, they are not related. So this is the acquisition. If any company acquire another company or the subsidiary of another company which is not related, then they will apply the acquisition method or purchase method. Now common control transaction. Now what another method is common control transaction. Common control transaction matlab acquisition of business or entity is within the group. If any business is acquired or entity is acquired within a group from group companies, then that acquisition is treated as a common control acquisition. If any acquisition happen within a group, then that acquisition is to be treated as a business combination. Acquisition needs to be done at book value. So suppose, for example, H Limited has three subsidiaries, that is S1, S2 and S3. S2 holds 100% to step down subsidiary D Limited and E Limited. S1 is acquiring D Limited from S2. That's the transaction is within the group. In common control transaction, accounting is to be done at book value, and in purchase method combination, accounting is to be done at fair value. And common control acquisition is done within a group, and in purchase method or acquisition method, acquisition is done outside. The example of common control transaction is, suppose holding company has three subsidiaries S1, S2, S3. So firstly, the H Limited has three subsidiaries S1, S2 and S3. Now S2 has two subsidiaries, that is, we call that it's a step down subsidiary of H Limited. So S2 has two subsidiaries D Limited and E Limited. S1 acquired D Limited from S2. Means who had acquired the S1, which is subsidiary of H Limited, acquired the step down subsidiary of S2, that is D Limited, from S2. So this transaction is called as a group transaction. Business combination includes merger, amalgamation, acquisition of legal entity, acquisition of business, transfer of business or entity within a group. Business combination includes the merger combination, the amalgamation combination, the acquisition of legal entity, acquisition of business, transfer of business or entity within a group. The accounting of computation of goodwill. How goodwill is to be computed, how accounting is to be done, and how computation of goodwill is to be done. Now, subsidiary accounting. In case If subsidiary accounting is to be done, line by line addition, 100% consolidation is to be done. Mean holding and subsidiaries ka line by line addition is to be done, that is 100% consolidation. Suppose H Limited is holding 80% in S Limited and A Limited holds 20% in S Limited. H Limited holds 80% and A Limited holds 20% in S Limited. Now balance sheet of S Limited, share capital and reserve surplus, that is 20 lakhs, liability 2 lakhs, total 22 lakhs, and fixed asset here 20 lakhs, current asset 2 lakhs, total 20. This is the balance sheet of S Limited, that is the subsidiary company, and balance sheet of holding company, that is share capital 20 lakhs, liability 16 lakhs, so it becomes 36 lakhs. Fixed asset 20 lakhs, investment in S Limited 14 lakhs, current asset 2 lakhs, so it total becomes 36. That intercompany elimination, if there is, if any, investment in share capital amounting to rupees 14 lakhs. This is the intercompany elimination. Balance sheet of, now consolidated financial statement is to be prepared. Balance sheet of consolidation on the date of acquisition, that is on the date when the H Limited acquire S Limited. Controlling interest in H Limited is more than A Limited, then consolidation is done by H Limited. Now consolidation, they acquire all the assets of S Limited, like fixed assets 20 and 20, that is 40 lakhs. Investment in S Limited is 14 lakhs by holding company, so they can eliminate this intercompany elimination because they invest in S Limited 14 lakhs. And now they acquire. In consolidation, what happened? Intercompany investment is to be eliminated because we had already acquired the share of that S Limited. So investment is to be removed, and in these the share of NCI, the elimination entry in the share capital, because we had made an addition of 20 and 20. We had taken the whole share of S Limited and whole share of H Limited, but and we have to reduce the share already acquired from S Limited because we had already acquired, so that share is to be reduced, and in the form of investment the holding company has acquired, so it will be eliminated from both sides. Like from investment it should be intercompany elimination, and from reserve it should be reduced. S Limited, share of S Limited and non-controlling interest. Non-controlling interest, who is there? A Limited is the non-controlling, which is also removed from H Limited. So share in non-controlling interest means is to be reduced from share capital, that is 6 lakh, and it should be disclosed separately in the consolidated financial statement. 6 lakhs, how it becomes? Because 14 lakhs is acquired by H Limited, so remaining is the non-controlling interest acquired by A Limited. So it should be reduced from the share capital, and it should be non-controlling interest is to be disclosed separately in the consolidation financial statement. And current asset of both the organization, like in these 2 lakhs and 2 lakhs, so it becomes 4 lakhs. And the liability is also 2 lakhs and 16 lakhs, so it becomes 18 lakhs. Now the total becomes 44 lakhs. So in this way addition is to be done. In the consolidated financial statement, all the assets and liabilities is to be added, and the investment is to be eliminated, and from reserve, and also the whatever investment is to be eliminated as intercompany adjustment, and non-controlling interest is to be disclosed separately in the balance sheet. And subsequently, if there is any profit in S Limited after acquisition, after they acquire, there is a profits in S Limited because they are not acquired 100%, so they are working of their own. There is existence of S Limited, so whatever the profit they earn, like if they are earning 5 lakh rupees, and whatever expenses, the net profit becomes 2 lakhs, These profits, subsequently after acquisition, these profits is divided into parent and the non-controlling interest. That is the holding company and non-controlling interest in the percentage what they have acquired the investments. So parent holds 80% stake. So it becomes 2 lakh. Whatever they earn the profits, though 2 lakh into 80%, and that is 1,60,000 added in the reserves and surplus of H Limited. Because S Limited, whatever they earn the profit, they distribute to the holding and the non-controlling interest. So 1,60,000 is to be given to the H Limited, so it should be added in the reserve and surplus of 1 lakh H Limited, and non-controlling interest. 20% interest is to be given to the non-controlling interest, that is 2 lakhs into 20%, so it becomes 40,000, which is added in the non-controlling interest balance sheet. Now, how do consolidation accounting is to be done? How consolidation is to be done? Subsidiary accounting, 4 accounting methods like subsidiary accounting is there, then associates accounting is there, then joint venture accounting is there, then joint operation is there. How these are the various methods of consolidation accounting. These are the various process of accounting like subsidiary methods, then associate methods, then joint venture methods, then joint operation. The various scenarios are there. Like in subsidiary accounting means if a company acquire more than 50% stake in another company, then it is a subsidiary account. Then it's create a holding subsidiary relationship, and Ind AS 1010 is to be followed for subsidiary accounting. In associate accounting, what happens when any company invests more than 20% but less than 50%, then it creates a relationship between the holding and associate relationship. It is not holding subsidiary if they hold less than 50% or more than 20%. So it creates a relationship holding subsidiary, holding and associate relationship. Joint venture, we have to follow Ind AS 28 and 111, and joint operation also Ind AS 111. Now in case of subsidiary accounting, what happened? In case of accounting, in that case, in case of subsidiary accounting, all the 100% assets or liabilities is to be added. Intercompany transaction will be eliminated. Investment in subsidiaries is eliminated while preparing CFS. If they are preparing consolidated financial statement, investment in subsidiary is eliminated. Intercompany transaction will be eliminated. 100% addition of asset and liability is to be made. Recognize non-controlling interest separately. Recognize goodwill and capital reserve is, if any, on the acquisition date by applying business combination accounting. So, they will recognize non-controlling interest separately, and goodwill and capital reserve, if any, on the date of acquisition by applying business combination. So, if goodwill arise, they will have recognized separately. If capital reserve arise at the time of acquisition, then on that date by applying business combination, they will recognize. In case if there is an associate accounting, if they acquire more than 20% but less than 50%, and it creates holding associate relationship, then Ind AS 28 is to be followed, and in that case what happened, equity pickup method will be followed. In that case, accounting will be done in as equity pickup method. What happened in the books of A Limited means who invest in the associate, or whatever percentage they acquire in B Limited is to be added in the books of investments, and also it should be charged to profit and loss account. So what happened in this case, it should, the profits which the associate company earn, the percentage which the company invest in the associate company, that amount of profit is to be added in the balance sheet of the investors company, in the books of the investors company. So now in joint venture accounting, what happened? Equity accounting is to be done, joint operation, proportionate accounting of respective methods of computation of goodwill. Suppose A Limited holds 60% in AB Limited. and B Limited holds 40% in AB Limited. A Limited holds 60% and B Limited holds 40%. In method 1, the purchase consideration is 60%. That is, who is the holding company in this? A or B? A Limited is the holding. So who will prepare CFS? A Limited. Now the A Limited only acquires 60%. So purchase consideration they pay for the net asset of 60% they acquired. So 100 crores less net asset, that is 60%, 60 crore, goodwill will be 40 crore. In method 2, what happened? They paid for the 60% they acquired, that is 100 crores, but they acquired the whole assets. That is 100% assets of the AB company, like 80 crores, and they also acquired the add the non-controlling interest in that, that is the 40%. For their investment they pay 60%, that is 100 crores, and for non-controlling interest they also pay 40%, that is 20 crores, and they acquire 100% asset, that is 80 crores. So that differential amount is to be treated as for goodwill, that is 40 crores. The amount is same, but the methods are two different methods. In this case, you pay for 60% only. You also acquire the 60% net asset. So differential will be the goodwill. In another case, what happened? You pay for 100% and you acquire the 100%, including non-controlling interest, and the differential will be the goodwill. Now the journal entries will be asset account debit, now goodwill account debit, to purchase consideration to non-controlling. Circumstances when non-controlling interest is recognized. In case of 100% holding, in this case there is no non-controlling interest and is not recognized. If A Limited acquire 100% stake in B Limited, there is no non-controlling interest, because nothing is acquired by another company. You had acquired the whole stake. But if you acquire 80% of that company and another 20% is acquired by another company, in that case there is a matter of non-controlling interest. In that case, recognition of 20% as non-controlling. Thanking you for watching my video. Please share, subscribe my channel. In the upcoming video, we will try to complete this standard 103. Thanking you for watching my video.